As of today, the residential solar companies in the United States have cheated the IRS out of about $50 billion. Now, that's a bold claim, but this issue has drawn the attention of Muddy Waters, Stanford University, Forbes, Time Magazine, and other serious investigators. It's starting to dawn on people that this industry has a massive problem in it. Now, unlike most fraud cases, the money here isn't just lost. The $50 billion can be recovered even if the solar companies themselves collapse. This money belongs to the American taxpayers, and since the law allows the IRS to take it back, it can and should be reclaimed. The scheme these companies use to steal the money is complicated, but the basic idea here is actually pretty simple. Residential solar companies inflate the value of their systems to claim more tax credits than they are entitled to. These counterfeit tax credits are then sold to corporations who reduce their tax bills while claiming they are supporting green energy. Here's how it starts. When a homeowner installs a solar system, they qualify for a federal tax credit called the Investment Tax Credit, or ITC. This tax credit is worth 30% of the system's fair market value, or FMV, as fair market value is typically abbreviated as. A typical residential solar system costs about $30,000, which means it earns about $9,000 in tax credits. Yes, residential solar systems are surprisingly expensive, and that's the catch. Very few homeowners can afford to pay $30,000 up front. They just don't have the money on hand. So they finance their systems. Some homeowners take out loans, some take out leases, but the most common financing option is to go with something called a power purchase agreement, or PPA. With a PPA, the homeowner pays nothing up front, and the solar company is also responsible for all of the operations and maintenance expenses on the systems for 25 to 30 years. In other words, the solar company pays for the system and then also pays to keep it running. In return, the homeowner buys the electricity the system produces at a price that is lower than whatever their local utility is charging. Under this agreement, the homeowners do not actually own the solar system that is on their roof. This means that the homeowner does not get the tax credit. So who gets the tax credits? The solar company bundles their PPAs and also their leases together and sells them to a shell company, which legally becomes the owner of the systems. The shell company is now responsible for managing the solar systems, including maintaining them and collecting electricity payments and eventually removing the systems from the rooftops at the end of the contract. So, does that mean the shell company takes the tax credits? No, there is another step here. The shell company is sold to two classes of investors. The first class of investors are the tax equity investors, and these are usually large corporations. They buy in to receive the tax credits and also the depreciation benefits, because the way the deal is structured means they can take that as a write-off. The second class of investors, the sponsor equity investors, take the cash flow after expenses are paid. And the sponsor equity portion of the deal typically takes the form of asset-backed securities that are sold to institutional investors such as pension funds. This is very similar to how subprime mortgages were packaged into mortgage-backed securities before 2008. So, the homeowners get solar and never have to worry about the maintenance. The solar company gets cash, the corporations get tax breaks. It seems like a win-win, right? No, the American taxpayer loses. When a PPA, or a lease system for that matter, is sold to a shell company, the solar company bases the price on the fair market value. The higher the fair market value, the bigger the tax credit. This creates a massive and irresistible incentive to inflate the fair market value. In today's solar industry, a $30,000 solar system with $9,000 in tax credits is magically transformed into a $50,000 solar system with a tax credit of $15,000. Every time a solar company inflates these values, $6,000 are stolen from the American people. So how does this happen? How do the values actually get inflated? Well, the IRS recognizes multiple methods to determine the FMV, the fair market value. You have the arm's length, cost, and income methods. The arm's length method is the preferred method. This is the price paid between unrelated buyers and sellers. By this point, over 500,000 residential solar systems have been sold for cash, which creates extremely reliable estimates for the arm's length prices. NREL, the National Renewable Energy Laboratory, and Lawrence Berkeley National Laboratory even publish average solar costs on an annual basis. This is basically a very roundabout way of saying that solar systems are sold for cash in a fair market on a regular basis. And the arm's length method says that their fair market value is their value in that fair market. It's a remarkably straightforward way to value something. However, residential solar companies do not use the readily available arm's length pricing because they can get higher FMVs with other methods. And the way they do that is they hire appraisal firms to inflate their system values using income models that are very easy to manipulate. There are many numbers in FMV income models, and almost all of these numbers can be manipulated. So let's just talk about 3 of them as examples. First, you have ignoring system removal costs. Second, you have understating operations and maintenance, aka O&M. And the third is you have the recursive ITC calculation. Solar systems typically last about as long as the roofs they are installed on. And to state the obvious here, you have to remove your rooftop solar system to replace your roof because the rooftop solar system is on top of the roof you are trying to replace. And at the end of a power purchase agreement, the shell companies that legally own the systems are contractually obligated to remove them. And this isn't just some cheap formality, it's a costly physical task that runs about $5,000. Now, you might assume that the shell company could just give the solar system to the homeowner instead of removing it. But after 25 years of wear and tear, the system is so worn out that the removal costs actually exceed the value of the solar system. So the solar system winds up being a liability, not an asset at that point. Under GAAP accounting standards, companies are required to set aside money for these future removal costs. But the shell companies are not doing that. This failure artificially inflates the fair market value of the systems, and if left unchecked, this could saddle homeowners with a large and unexpected bill when the contract ends, because the shell corporation is designed to run out of money and shut down. So if they don't set the money aside, there's no one to pay the bill. The homeowner will just be stuck eating this huge expense. The shell companies are also responsible for keeping the systems operating for 25 to 30 years. And a lot can happen that time. A tree can fall and break a panel, a squirrel can chew through some wires, inverters can fail, and the systems just get dirty, so someone has to periodically climb on the roof to clean them off so the sunlight can get through. Residential solar companies dramatically lowball the cost of the O&M, and this inflates the FMV and gets them a bigger tax credit. And the lowballed O&M is the biggest contributor to the inflated FMVs. However, in order to keep this secret, the solar companies have to pay the difference while pretending the shell companies are independent, and that's why residential solar companies are running out of money despite stealing so much money from the American taxpayer. And if you want a really good look into how this happens, one residential solar company, Sonova, managed to screw up and leak their second set of books, and I have a series of videos walking through their second set of books. In the third video in that series, I show you line by line exactly how Sonova conceals their massive O&M expenses from investors. So, I mean, if you want to see some hard evidence to back up what I'm saying, that's where you can go see some hard evidence. The most deceptive tactic to inflate the FMV, however, is the recursive tax credit. What is 30% of $100? You would think it would be $30, but in solar math, it's $42.85. How can that be? Well, the residential solar industry takes a tax credit on their tax credits and then tax credits on those tax credits, and on it goes. This logic turns the 30% tax credit into a 42.85% tax credit. This recursive tax credit was disallowed in federal court in the 2023 Alta Wind case. But despite this, residential solar companies still use it in their FMV models today. And the IRS does not actually look at the models or the appraisals, they just see the end result the companies are claiming. And that's how residential solar companies get away with their FMV fabrications. The IRS does not actually require the receipts, they just require the paperwork. A spreadsheet is enough to justify tax credits. And once the residential solar companies realized they could print money by inflating the fair market values on paper, the floodgates opened. Companies started sending in documents and then walking away with millions or billions of dollars in extra tax credits. One company, DC Solar, even claimed tax credits on systems that never existed, and that resulted in a $1 billion fraud. Berkshire Hathaway, who bought some of the counterfeit tax credits, was forced to repay $380 million to the US Treasury. Warren Buffett, one of the most successful investors of all time, fell prey to solar industry shenanigans. So, how do we get to $50 billion by inflating FMVs? Well, let's do the math. Roughly 7 million residential solar systems are installed in the United States. Roughly 5 million of those systems used PPAs or leases, which are closely related to PPAs. Another 1.5 million were financed through loans. The rest were cash sales. Research into company financials shows that FMVs on PPA and leased solar systems have been inflated by at least $2.70 per watt. The average residential solar system in the United States is about 7,400 watts. So this means that the value of each of these systems is inflated by about $20,000. With 5 million PPA or leased systems, that means we have about $100 billion in inflated fair market value. With a 30% ITC, that's $30 billion in inflated tax credits on the PPA and lease systems. However, the ITC rate has actually changed a little bit over time, and adjusting for the occasionally higher ITC rate adds about another $9 billion. And the inflated depreciation, remember the tax equity investor gets to take that as a write-off, the inflated depreciation benefits on the PPA and lease systems adds another $9 billion. So for PPA and lease solar systems, the total fraud is about $48 billion. But that's not quite the end of it, because many of the loans that homeowners took out for solar systems were also manipulated. Basically what happened here is that the residential solar companies would lowball the interest rate on the loans, but then inflate the principal, and this in turn inflated the apparent value of the solar system. These are predatory loans. Research showed that these loans generated about $3,000 in counterfeit tax credits per solar system, which adds another $5 billion to the fraud. So the grand total residential solar tax fraud is about $53 billion. This money was taken from American taxpayers, and we can get most of it back. The law is crystal clear here. If you use fake tax credits, you're still liable for your taxes even if you did not know the tax credits you were buying were fake. The $48 billion in PPA and lease fraud can be recovered from the tax equity investors. These are big, profitable corporations that had every opportunity to verify the FMVs but chose not to. They are still liable for the taxes, and they are able to pay them. However, the $5 billion in loan-based fraud is harder to recover. Homeowners were often misled, and clawing back tax credits from them would be tedious and politically unpopular. However, many of the individuals who actually made the predatory loans, not just the companies, but the specific individuals who worked at the companies, have personal liability for helping homeowners to understate their taxes in this way. The specific law is US Code 6701 if you want to look it up. Personally, I think it is deeply unfair to hold homeowners responsible for getting defrauded when there is a law that would enable the government to claw back the money from the perpetrators who did it. It's important to remember that the terms of the homeowners' loans said they had to take the tax credit and then give it to the people who made the predatory loans. So the homeowners took the tax credit, yes, but they didn't actually get the money from it. They were just tricked into being the middleman. It would be absolutely unconscionable for the government to go after the individual homeowners when there is a law that says they can go after the specific individual people who made the predatory loans in the first place. So, how do we recover the $50 billion? Well, there are 3 steps. First, we need to identify the tax equity investors. There were about 150 major corporations that participated in around 1,000 tax partnerships. Publicly traded installers such as Sunrun, Sunnova, and SunPower list these tax partnerships in their SEC 10K filings. The IRS can request the deal documents to identify the investors. The IRS could also audit the large banks that put the tax partnerships together, as their records will identify the tax equity investors. Second, we need to determine the FMV inflation. The IRS can obtain the appraisals that were used to determine the FMV in each deal, or they can simply revert to the arm's length prices available from NREL or the Lawrence Berkeley National Laboratory. Third, and finally, the installation should be audited. It's entirely possible that tax credits were taken on solar systems that do not exist, or they were taken on the same system multiple times. In fact, there actually is some evidence indicating that may have happened. This is the largest tax fraud in US history, and it is still growing. As of today, the fraud from FMV inflation alone is $53 billion, but there are other problems. That $53 billion figure assumes all the solar systems actually exist. There's also evidence that there was securities fraud in asset-backed securities. There was securities fraud in financial reporting. There was consumer fraud in predatory loans. And there are servicing failures on the 25 to 30-year contracts. The investigation here is just getting started. Thank you for watching. If you want to see my video walkthroughs of Sunnova's second set of books, click right here. And if you like and comment, the algorithm will promote this video to more people and help get this information out there. Also, don't forget to subscribe and ring the bell if you want to see my upcoming videos.